I would like to dive a bit deeper into what's under the hood of these numbers. Because one thing is, again, you see the rolling 12 months, or you see the quarterly numbers, but you need to look at it, I think, on a slightly bigger, with a slightly bigger perspective. And the biggest perspective is, of course, that 10 years ago, this didn't exist. Only the OS part existed. 9% of our business that we have discussed today existed. That's kind of interesting. To help me drill down into these numbers, I would like to invite Håkan. Håkan joined Enea back in 2009, and he worked with me as a corporate development and later CFO when we were trying to sort of find this business beyond OS. But you've left Enea, Håkan. Why are you here?
Well, since I left end of 18, I moved back from the US to Sweden with my family and been doing a little bit of CFO work and consulting, and since 1 year roughly, I'm back supporting Enea on a consulting basis, and that feels actually great.
Yeah, isn't it great to see Jean-Pierre, Amar, Osvaldo, and all these people, John, delivering these beautiful results?
Oh yeah, I mean, it's absolutely fantastic, and this is, again, a journey that was initiated many years ago, and still, we're early in the big book of Enea, early chapters still.
Yeah. Why do you think we've managed to keep all these great people?
Well, I think there are a couple of reasons here. First, the acquisitions that we made, I mean, clearly it's about the people. On both ends, I say. Good people is sort of a must, and we have great people both in the acquisitions and on the sort of receiving end here. And second, I'd say the business model or the integration model, and we touched upon that, whereas centralize what you must to distribute what you can. That was a good one, or if it was, but okay. But the point is this: what we do is we balance a global sort of integration model with keeping strength and leverage on the local level, and that balance, I think, is very, very important. Third, I'd like to just add the culture. The people here are very loyal to the customers, loyal to each other, and there's also great performance culture. These guys like to win, and that's also what I think is really important, why this works.
I couldn't agree more. So let's jump into the numbers actually, and we skip this because we don't have time. And here, I know that you have something to add, Håkan.
Yeah, I mean, when you look at a couple of comments then to all this. Looking at the top line of Enea, you might look at this is a sort of flat business, but there is lots of action going on underneath the surface. So you had a declining legacy OS business, clearly a challenging 2023. We have sort of repositioned the efforts in the focus areas, adjusted investments and putting more efforts into cybersecurity, and also accelerated recurring revenue, and we'll touch upon this. Clearly, the dilution from the declining OS business is coming to an end. Think about this, that in 2015, this was a 331 million revenue business. Now it's single digit as a percentage of the total net sales. Looking at the focus area, as we have heard, we had double-digit growth in these focus areas for both 22 and year-to-date 24. Again, 23 was a little bit rougher, but very important. We had 15% recurring revenue growth within the focus areas during that period. And over all this time period, we have been propelled by the security growth. So you have an average growth rate here of 14% during these 2.75 years. Now, not all revenues are equal. We've been touching a couple of times here on the recurring revenue. You know all about recurring revenue, repetitive revenues that are typically time-based, such as subscriptions, support and maintenance, time-based production license, those type of things. During the 3 years, Enea's recurring revenues has grown from 50% of total net sales to 70%, and that's remarkable. Now, remember that the legacy business is 100% recurring, so how do we do in the focus areas? Well, we've been growing recurring revenues at an annual growth rate of 12%, and the share is now up to 67% in these focus areas. Looking at this on the annual picture, the total annual recurring revenue of Enea is currently, on a 12-month basis, measured end of Q3, 600 million Swedish, which represents 67% of net sales. And the majority of this, and a growing majority of this, comes from the focus areas. And I think this is very, very encouraging in order to sort of think about future growth. Moving on to profitability. So 3-year performance of EBITDA, I believe this is a relatively solid picture. So we hit 34% adjusted EBITDA, 34% and 33% year to date. And about half of the quarters, we were actually above the financial ambition. So almost there, but clearly above the guidance for this year, which was 30%. Cash flow is an interesting measure, and when you look at the cash flow statement, many of you are analysts here, the way I like to look at this is to sort of understand what is actually the raw business producing here. So what I did, I took out the changes in working capital to sort of get away from a little bit of the volatility. I adjusted for non-recurring items. I adjusted for unrealized FX effects. This tends to go a little bit up and down to get sort of to the raw business cash flow. And you see here that we're trending at annualized level of, let's say, 170 to 200. I like to say that Enea produces cash flow 200 million a year, but okay, 170 to 200, which is roughly 20% cash margin on net sales. And I think this is fantastic. If we extend the time period and looking at the 5-year, now in this picture I choose adjusted EBITDA less CapEx, something that Rasmus at Redeye refers to as EBITDAC. And you'll see also here, I believe this is a solid profit delivery. Normalized level, I'd say, is between 200 and 240 million a year. Redeye's estimate for this year is 215. So again, a solid performance. However, if you map this with the share price, you'll see that things are not as solid, referring to the share price. The interesting thing with this chart is that you both have the EBITDA less CapEx in $1 million and the share price in SEK on the same chart. And you'll see there that we clearly experienced a multiple contraction in 22 and 23. However, we recovered a little bit. So where do we go from here? In order to sort of address that, I would like to introduce a reference point. That reference point being something referred to as the Nordic SaaS peer group, software as a service peer group. This is a group of 41 companies that is covered by, among others, Redeye on a quarterly basis. 41 companies with, I'd say, a varying degree of SaaS features. As you'll see here, Enea with 70% recurring revenue, we have from a business model perspective, clearly some significant SaaS features in that aspect. Okay, so one of the measures that this group is measured on is something called Rule of 40. I'm sure most of you know what this is, but it's a combination of net sales growth and profitability. And sort of the concept goes that being a healthy SaaS company should ideally have a combined net sales growth plus profitability above 40%. If you run this for Enea with, let's say, 11% year-to-date revenue growth, focus areas, EBITDA year-to-date 33, less CapEx 10%, you're at 34% Rule of 40 score, 34%. Okay, this group on average is 13%. So when we look at this group and sort of try to position ourselves from a Rule of 40 perspective, we end up in the upper half and more or less exactly in the middle of the upper half. The upper half has a median Rule of 40 score of 32%, and we are at 34, so slightly above. That's the introduction of the reference point. So where do we go from here? Well, it's up to you. The story goes, you should never comment on share price, right? So I will not do that. I will only stick to the facts and give you some data points and leave the opinions to you. Going from below and up, 2023, 57 kronas, Enea's volume-weighted average price during 2023. 100 SEK, that's where we were at least a couple of days ago. 2022, somewhere between 125, 130, the average price that year. If we apply now the median enterprise value to sales multiple of 3.6, back to this peer group, full peer group median multiple, to our revenue as estimated, again by Rasmus, we're somewhere, the share price, that would mean that the implicit share price would end up at somewhere around 150. Again, 2 data points being the historical average prices. But remember, I said, we match actually perfectly well with the upper half of this peer group, as we score 34% versus 32, being the median score of the upper half. So here I applied the group median on enterprise value sales of 5.7. I applied the average enterprise value sales multiple of this upper half peer group of 6.5. And finally, I applied the implicit EV to EBITDA multiple of almost 40 of this particular peer group. And you'll see what that sort of means implicitly, multiplying these sort of key figures with the relevant metrics of Enea. Again, data points, and I will leave the opinions for you. Thank you so much.
Thank you, Håkan. So before we hand over the responsibility of opinions, you being an outsider now, what's your own opinion on this?
Well, for me, the good news is actually this, that the dilution is coming to an end. Recurring revenue is on a decent level, and to me, that gives me comfort that we have a pretty, or actually very good future. So I feel good about this. I have share some out.
Okay, thank you for that. So with that, thank you, Håkan, but please stay. Ulf, if you can please come back here. And Hanna, if we could open up for some questions on the numbers, please. Ulf.
Okay, thank you again, and thanks for the presentation. I forgot to mention that earlier. Simon Granat here with ABG again. And I was wondering a little bit on your financial targets here. You're targeting double-digit growth in your target areas. Do you feel like you have the capacities in place to achieve this regardless or not whether the market improves? And I say this in wake of the recently still lukewarm telecom market. Thank you.
Yeah, so thank you for that question, and I will come back to that actually. But let me try to answer the question anyways, right here and right now. So that's nothing I would like to commit to at this point in time. So it's still another culture of Enea, and something that we want to instill in all our operation is that, you know, to over-deliver, not to over-promise and under-deliver. So I cannot, and Enea cannot, nor predict the market or change the market. The market conditions are, as you rightly say, we feel them too. Yes, you know, slightly lukewarm. But we are operating within that market, and I don't think it's, you know, there's some great niches in that market that we are addressing, but the overall market is a bit lukewarm. And so that's why we're still holding on to our Snuttefilt, the focused areas. 10% OS, it's still percent on 9% OS, it's still 9-10% OS, it's still slightly below 100 million. And with that going down at 18-20%, it is still diluting the numbers, but it will come down further over the next 12 to 24 months. So the answer is, today we're not going to change the numbers, and we're not going to give you new numbers, new ambitions, new guidance. But the long-term ambition we have is very well, you know, within reach, and we've already been there in our focus areas. So that is the answer I will give you on that.
Thank you, Fredrik Littard from Handelsbanken here again. Thanks for all the presentations, very interesting to listen to. I wanted to come back to your strategy, the E3 with evolve, enhance, and expand. And you are around 650 employees total, and you have great positions in several sub-segments. How are you going to sort of choose where to invest your R&D capabilities in order not to make you too thin on new areas and all of that? So how do you prioritize your money?
Yeah. So that thank you, Fredrik. That is, of course, a million-dollar question, and one of the key questions we're working on. We don't lack investment opportunities or requests for investments. On the contrary, we have loads of them, and we took a slight wrong turn here in 21-22, where we overinvested in our own product development, not based on that there wasn't opportunities, but we just simply couldn't deliver on all the opportunities at the same time. So we have a thorough investment board process that Osvaldo and his team is leading, where the majority of our 24% R&D investment goes into the day-to-day improvement of the products, more or less in accordance with what we've already sold. And then the enhancement is also going through the product management process of what of all the requirements we have that we can prioritize. And then the smallest portion goes into adjacent markets, new things. But that's a small part of the 24%. And as long as we are here, we're going to keep that a very tight process. So both the sales side of things as well as the R&D side of things, to keep that a tight ship and invest, but not think that we can sort of invent the most fantastic product never yet invented, because that is simply not Enea. That's the work of other companies. Do we have?
Thank you, Daniel, Handelsbanken again. Also, thank you for a great presentations here today. I was thinking, Anders, if you could comment a little bit more on your current M&A strategy in terms of adjacent markets, but also we heard that decryption must be quite important nowadays. We have quantum safe networks, etc., being sold by some suppliers and so on, that should make the network more safer. Just your thought on any white spots.
Yeah, no,
Thanks.
but of course. So thank you again, and this is an adjacent question to the question from Fredrik. So we do not think, and I do not think, that we should pour hundreds of millions in own R&D to invent the things not yet invented, or to invent things that someone else have already invented. I think we should improve our own product development, and we should enhance it, and we should add what you've heard a lot of things today about AI, and then gradually improve the product. And instead, we want to increase the portfolio and with acquisitions. We've done that successfully, and that's the reason why we again can present the company we're presenting today. But we don't want to become an acquisition machine that we have, do 2-3 acquisitions a year and just pumping up the numbers. We want to do strategic acquisitions. We want to be able to integrate them. And when it comes to these acquisitions, it's about channel to market, it's about geographic distribution, but it's also about product. And when it's about product, it's very much so that it is within the cybersecurity space that we would like to strengthen our portfolio. And it's also very much in security outside the telecom operators. So if we meet again in 24 months, I hope that Enea has an even stronger security portfolio, and we have an even stronger operation outside the operators. But I don't want to give you a product. I don't want to give you a white spot, and even that would be weird. So I cannot answer, and I wouldn't want to answer that part of it, the question.
Andreas Joelsson, Carnegie. Thanks a lot for this, and I will have a follow-up to Handelsbanken's fine questions. What is the risk that you have too many focused areas? There has been a lot of examples of companies with too much or too broad product portfolio. So how do you make sure that you have the focus, and also how you get the synergies out of the various products that you have?
Thank you for that, Andreas. Yeah, those are very well-connected questions. And for me, it's like, I can argue it's what I'm doing, actually. Beside trying to create a winning culture, I'm trimming my hedges. I'm trimming all these beautiful ideas and wonderful thoughts about new markets and new initiatives that is coming from salespeople, great salespeople with great ideas and great initiatives. And they back them up with, oh, this is the fantastic opportunity, as well as great engineers and great product managers with amazing products they want to develop. Because I know that was really embedded in your question, that if you have too much focus, too many focus areas, you don't have enough focus to win. And at the end of the day, that's what it's all about. It's not having a great portfolio, it's about winning the deals. And in a software business, it's very much about winning deals. And in a dull market, it's even more about winning the deals. Because in our industry, if we bid for a deal and we win it, that money is more or less 100% contribution, at least plus 80% contribution. If we bid for the same deal and lose it, it's zero. So there is no prize for the number two. And this is a message that I've been preaching all the time. And the way to do it is, first of all, you need to sort of align that is your opinion. And you need to select a management team that appreciates this and understands this and can run with this message. So if you tell them that this is not like the discussion with Amar, it's not like Stratum cannot create opportunities, but we cannot afford to have more Stratum opportunities right now, because most certainly we wouldn't win them against the big guys, and if we would win them, it would dilute our efforts to secure the customers we have. So, sorry, I know you have opportunities, but you're not allowed. Focus on traffic management and our firewalls business. And Jean-Pierre focus on our embedded security products. And so how do we secure that that's not happening going forward? Well, you have to secure it. No one else will do it for you, because if you leave the organization running, you will have a mess. I guarantee you. That's my best answer. All right. Anyone else? Let me check here. And if not, we actually have a question here. Your long-term ambition is including M&A, or is it pure organic growth and M&A will come on top? Well, the long-term ambition is the organic development of the company, and M&A will come on top. That's the answer. So, okay, we will now also have the opportunity to you will have the opportunity to meet our incoming CEO, Teemu Salmi, and he will present himself, and then you will have the opportunity to ask a few questions if you have any.